Jane, I mean, we have the governing council that's going to be meeting for the ECB next week. Would you agree that conditions have moved in such a way on the inflation front that it would justify the kind of steps that are being implied here?
Well, I think the increase in inflation certainly gives a little bit more support to the hawkish camp, and we know by looking at the minutes of the ECB meeting over the last couple of months that there is a discussion, or there already has been a discussion about whether or not it is time, or time is approaching for the ECB to rein back on some of its stimulus. But I think what we've got to watch out for is not what the hawks say, because we know that there are a couple of hawks in the ECB. We know their point of view. What we need to watch is to see whether or not the doves begin to shift their position. And I think it's probably still too early to say that. Now, when we look at that 3% inflation print that we had yesterday, most of that was because of energy. Now, admittedly, the core number was still a little bit above the market consensus, but not by much. If we look over the summer, we know that we've had this big story about European gas prices. We know that Gazprom and Europe, for instance, they're engaged in negotiations about pipeline. So in a way, I think we can put that to one side, and we need to see core prices pushing up first, I think, to really get excited about an ECB change in policy.
I mean, I'll tell you what, Jay, we did see quite a bit of movement in European bonds, and specifically German bonds. The markets live team is asking the question of the day around the fate of the German bond. And yes, we're still deeply in negative territory at 38 bips, negative 38 bips. But when will they climb to zero?
You know, I think we've still got a long time to come before that happens. I mean, if we look at the European economy historically, it is an environment where there has always been a need for structural reform. If we go back to pre-pandemic days, there was so much pressure for the need for structural reform. If you look at the labour market, it's still quite rigid compared with, say, the US, even the UK. All of these factors, the demographic too, that they play down to this story that you're probably not going to have the same degree of inflationary pressures that you have, for instance, in the US. And historically, CPI inflation in the Eurozone lags that of the US too. So I don't really think that we're in the sort of environment just yet, despite this big headline print, that we can really talk about a significant change of environment long term for the Eurozone. And I don't think we're yet in the position where we can talk about bund yields back at zero either.
Let's circle back to the United States. And we had the consumer confidence numbers at the same time. The dollar in focus. You're suggesting that a lot of the interest that we've seen in the greenback is not so much around policy, but more as its role as a haven. Is that right?
Well, you know, I think there's been two real factors over the last few months that have driven the dollar, and this is really since June. And first, of course, was that hawkish tilt from the Fed in June. And what was important about that particularly is that it pushed up the argument or the debate really about whether or not there could possibly be a hike in the Fed's funds rate in 2022. Now, if we look back at what Powell indicated at the Jackson Hole, he wanted to separate out the debate about tapering to the debate about interest rates and pushing the interest rate argument back, if you like. That is potentially dollar negative. Now, the other factor, though, that has been supportive of the dollar, we've seen pockets when we've seen some safe haven flow, particularly, I think, in the last few weeks when we've seen Asian markets lag those of the US. If we look at the MSCI Emerging Market Index, for instance, we haven't seen that perform in the same way as the US S&P, for instance. And I think that reluctance of investors to push back into emerging markets automatically supports the US dollar. So I think for the dollar to really sell off and to really weaken, we need this big confidence to return in EM, and that's not happening just yet.
I mean, we'll get to China and EM in a bit more detail shortly, but just within G10 FX, just highlight, with obviously the greenback discussion we just had, just highlight for us your top trade.
Well, you know, I think the dollar has the opportunity to stay firm for the next few months. I think going into the European winter, I think there'll be plenty of concerns about COVID, how that's going to impact growth. I think that's probably going to keep people long of the US dollar. That said, you know, if we imagine that the dollar does remain strong, I think there is the Aussie is likely to remain on the back foot. Even though we've had stronger GDP data, I think there's lots of concerns about the full reopening of the economy. That may not happen until till November and maybe even beyond. So I think that one could remain on the back foot. And I think sterling is interesting. I think cable still looks a little bit far away if we're looking at 140. So sterling, though, if we do get a slightly more hawkish Bank of England into year end, I think that could make some gains against the euro.
Explain to me why the PMI numbers out of China have been largely taken in stride by the market, even though they were quite a disappointment.
They were, but of course, this is not the first set of disappointing data that we've had from China. So, in a way, some of this is becoming priced in. Again, if we refer to the emerging market stock market, we've seen that underperform now for quite some weeks. So that there is a lot of news out there with respect to China. However, that said, although we didn't see any knee-jerk reaction to this, it does help build a story, and I think that the market is concerned about slowing growth in China. We know about the tech story. There are signs that the market is becoming perhaps confident that that might be or may have more or less run its course if you look at some of the stocks today. But to be honest, I think there is a big concern out there about what the clampdown on tech will do to entrepreneurship, what it will do to the private sector in particular, and what it can do to growth. So I think there are concerns about China. I think if we bring that through into concerns that are remaining persistent about the Delta variant or any other variant over COVID, we still have quite a lot of anxiety in the markets, and I think this really is pulling into why the dollar is still quite firm.
Yeah, but in relation to that, the Chinese yuan has also been quite resilient, and you could make the argument that there is quite a bit of room to maneuver in terms of letting it weaken to allow it to act as a release valve to kind of dissipate some of the pressures that have been building.
Indeed, I mean, currencies that most generally are a buffer to economic growth, and that is the natural movement that you would expect to see, particularly if we do get more policy manoeuvring by the PBOC, if we do get some further stimulus, which a lot of people are expecting. But of course, this isn't a freely floating exchange rate. We're not going to see the normal moves that you would normally have in the market, but there is the possibility that we will get it being fixed a little bit lower if these concerns about growth do persist.
We saw the Chinese government bond yields just get a little bit lower, 2.82%, down 2 bips. Expectations that we might get more easing from the PBOC. Is that now within the realm of most likely possibilities, would you say?
I think so. I think there's been a lot of talk that we will have a lot more easing from the PBOC in the next couple of weeks, and certainly over the course of the quarter. I think that probably is, as you say, you've seen that reflected in the bond yields. And I think if we carry on getting softer data, I think the market will come to expect that if it hasn't already completely priced that in already. So the market watching the data, but the softer data is no longer the shock that it was. So, perhaps on the more positive side, looking at China, we did have the news a week or two ago that they again had reached 0 cases now in terms of COVID. Now, that is good news because we know that they were having a no prisoners approach really to COVID. They were shutting down ports if there was just one case of an employee. If that has helped all but stamp out the virus for now, then maybe the market can be a little bit more optimistic that COVID won't be such the downside risk for the economy. That said,
Right.
I think we all recognize that COVID will continue to be a cloud in the sky for most economies over the coming months.